Hello and welcome to another of the Kafafian Group's Banking Shorts. Today, we're going to take a look at how the big volume of mortgage originations has impacted the profitability of mortgage products within community institutions during the first half of 2020. So let's go to our first chart. So our first chart, we're just showing the mortgage volumes over the last 5 or 6 years here and taking a look at how high those volumes were for the second quarter of 2020, which represented 2.7 million loans originated. And you can see the breakdown. Refinancing represented 62% of that volume. And this will not surprise anyone that works within a mortgage department in a community institution. So now let's take a look at how that's impact the profitability of the products. So a little background here. We measure the performance of the mortgage department within 3 distinct products. We have the mortgage portfolio, the secondary market, loans sold, and then loans service. If we take a look at how we complete the profitability for our clients, we try to aggregate all the costs associated with mortgage lending and put it into a mortgage department. That includes your direct costs. That'll include any support costs from maybe a compliance area, loan operations area, so we can get the total costs within that department. We also do a transfer pricing, so we know what the interest income on the loan is going to be, but we use the advanced yield curve for the Federal Home Loan Bank to lock in a spread. For instance, if you have a 30-year mortgage, we'll do a discounted cash flow of that mortgage to get what the average life would be, and it might be 7 years. What we'll do is when the date that loan is put on your books, we'll lock in a price on that 7-year borrowing rate from the Federal Home Loan Bank advanced yield curve. So the spreads are locked in for each of those loans. Okay, so let's take a look at the actual performance in the first half of 2020 compared to the whole year of 2019. So the top chart here, we can see the mortgage portfolio return on assets, relatively the same, 128 versus 129. Right? Very consistent. When we take a look at the annualized profitability for each loan within that mortgage portfolio, we can see in 2019, it was $1,800 and almost $2,000 the first half of 2020. The increase in 2020 is due to the larger loans being originated versus the loans being run off of the bank's portfolio. Okay, so pretty consistent earnings there. Here's the big superstar so far in 2020, the secondary mortgage market, the loans that you're selling. Look at 2019. Our banks actually lost $601 per loan. Why is that? We'll get into that reason in a little bit here. But look in the first half of 2020, banks are within our service group made $1,300 per loan sold. That's a big turnaround, right? Our last product, our servicing loans. In 2019, the annualized profitability was $6 per loan, but take a look of the impact of, because those volumes of loans that are being paid off within running off your portfolio, it impacted those mortgage servicing rights that had a longer life of those loans being held within your portfolio. And you can see there was actually a loss of $53 per loan, okay? Now let's take a closer look at why we started making money in the secondary market in 2020. You can see the first quarter of 19, our clients sold 458 loans for a net loss per loan of $3,900. And take a look at the volumes of loans as they increase throughout 2019. We get to the fourth quarter of 19. Our clients sold over 1,000 loans and they eked out a profit of $154 per loan sold. And now we get to the second quarter of 2020, where our clients sold over 1,800 loans and were able to have a profit of $2,100 per loan, right? So we can see as the volumes increased, the profitability certainly increased. Chart D we're taking a look at, this is the total of loans originated for the portfolio and the loans that were sold from all of our clients. So we can see the total loans originated within a portfolio and loans sold in the first quarter of 19 were a little over 1,000. The cost to originate that loan was $8,400. You might say there's no way, but with those loans volumes so low, that's what it cost. And we can see towards the end of last year, the fourth quarter, they more than doubled the loans that they originated, and they got the cost per loan under $5,000. And this is where they started to make a profit. This $4,600 to originate a loan is kind of the normal cost that we see in normal markets, okay? Now let's go to look what happened in 2020. We can see in the second quarter of 2020, our clients originated over 3,100 loans, right? And look at, drove that cost down per loan of about $3,900. So we can see this by this chart, look at the different capacities. And I don't see a lot of our clients adding a lot of people during the last few months. These people are just working harder. So the question is, what is your capacity within your mortgage department? Is it 100 loans or is it 50 loans? And what happens when it drops down to that 50 loan basis? So as we look at banking today for community institutions, this could be a tough remainder of 2020. 2021 doesn't look that promising either. We're probably not going to see the profits we made in 2019. So what can you do? I think one step you can make is once those originations start to drop, because refinancing will end sometime, and if the new loan volumes don't increase substantially, you're going to have excess capacity within your institution for originating mortgage loans. The large banks, mortgage brokerage companies, they base their resources on their, the capacity they have at that time, the level of originations. We know that's not a normal thing for community institutions to do, but I think going forward, we have to look at the bottom line, and you might want to start looking how you can kind of have a variable capacity for the different volumes of originations you have within your mortgage department to make it profitable, not only in good times, but also, quote, normal times. So if you want to know anything else more about what we covered today, or if you have any questions about product profitability or organizational profitability, my contact number is up on the screen now, and please contact me at any time. So once again, this is another, the Kafafian Group Banking Short. Thank you.